Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 87, we're going to look at a case for Roth conversions by taxable estates. To examine this, we're going to dig into a technical advice memorandum from way back in 2004, but we're going to examine the interplay within an estate tax calculation between income taxes and IRA distributions. And as always, this presentation is not intended to substitute for legal or tax advice. Now, to preface, a lot of our discussion today is only really relevant if you have an estate tax liability to begin with. But even though that's not as common today, that could become more common in the future. So really my goal in presenting this discussion today is to plant a bug to look at how these interplays between the estate tax and income tax should be calculated and forecasted in the case where a significant portion of the estate might be made up of IRAs, and especially when you might have to raid the IRA to pay any estate tax liability. Now, you can deduct, as an estate tax calculation, your claims against the estate and your expenses of administering the estate. Now, income taxes do fit into this, but what we're going to see is that they typically are limited to income taxes that are incurred before death. Those are more in the nature of claims. Now, you can deduct certain expenses incurred after death, which are more in the nature of administrative expenses, but as we're going to see, that doesn't include income taxes that are incurred after death, as might be the case if an estate is the beneficiary of an IRA. Now, there's also a corollary to this for beneficiaries as well, which we've discussed in a previous episode, in that beneficiaries of an estate who are taxed on income in respect of a decedent can get a miscellaneous income tax deduction for the estate tax that was borne by their share of that income that they're taxable on. Now, that would be the most common example would be an IRA. So you might have a beneficiary who is the beneficiary of an IRA and receiving distributions from it, but that IRA incurred estate tax as well. Now, it seems unfair to subject the same income to both an estate tax and to an income tax, and that's contrary to what Congress intends. So because of that, under Code Section 691C, that beneficiary would get a deduction against their income tax liability for any estate tax that was borne by that IRA that's being distributed out to them. Now, that deduction can be computed in a taxpayer-friendly manner, as we walked through in that previous episode, in that you can treat the income in respect of a decedent as being last dollar in the estate, so it gets the maximum benefit of that 40% deduction, and the beneficiary could even front load that deduction to the early years of distributions that are treated as income in respect of a decedent. That might be the case, for example, with an IRA. Now, if the estate is an IRA beneficiary and is forced to take a taxable IRA distribution, how do these two interact? The deduction for income taxes and potentially this estate tax deduction for income tax purposes. That was covered in an IRS technical advice memorandum from 2004, as I mentioned, under which the IRS examined a situation where the estate was a beneficiary of an IRA but didn't have cash sufficient to pay the estate tax without dipping into that IRA. So what happened is that the estate liquidated the IRA, but it also took that Code Section 691C income tax deduction and still had an income tax liability at the end of the day based on that deduction. So what the estate did is it claimed an estate tax deduction for the net income tax that was due after taking that 691C deduction into account. So what happened? The IRS disallowed the estate tax deduction for those net income taxes for two reasons. One is that there's a statutory provision, Code Section 2053 C1B, which prohibits the deduction of income taxes that are incurred after death, which was the case here. It was the estate itself incurring the income taxes by taking an IRA distribution when it didn't have to. Now, what the estate tried to do here is argue that it was necessary to liquidate the IRA to pay the estate tax, which made the income tax on that IRA distribution more akin to an expense of sale, which would be more like a post-death administrative expense, but the IRS didn't bite on that argument, mainly because that statute that prohibits deductions of income taxes incurred after death served as a hard bar to converting that into an expense of administration. So looking at this, we now kind of look at the mathematics. We had this income tax that we couldn't deduct, but ultimately, could we have avoided that with a pre-death Roth conversion? Would that be a good idea? Now, I can't represent that this would work in every scenario, but we're going to work through a small example that may have some imperfections, but may be a good forecast of where this might work. Let's assume we have a taxable estate of a single individual, and the taxable estate is $14.2 million in 2021. Now in 2021, the estate tax exclusion is going to be $11.7 million. So we're going to have essentially $2.5 million of this estate that's taxable, and we're going to have a $1 million IRA in the estate as well. Now, if there's a traditional IRA and we're following these facts from this technical advice memorandum, what we have is a total estate tax of $1 million. That's 40% of that $2.5 million. And the estate tax attributable to that IRA would simply be 40% of the IRA amount, or $400,000. Now, after taking a 691C deduction, if the estate withdraws that $1 million from the IRA, there's a net of $600,000, which is the estate's taxable income. And calculating out the tax brackets for 2021 and assuming a flat 5% state income tax rate, we'd have an estate income tax of $250,000 and change, and it would leave a net estate of $12,949,682. Now, if there had been a Roth IRA conversion immediately prior to death, using these same tax rates, there would have been a little more income tax. It would have been $364,072. That would leave a net IRA of $635,928, which would leave a smaller taxable estate. And after taking the estate tax out on that taxable estate, we'd end up with a net estate after taxes of $12,981,557. So in this case, the Roth IRA conversion prior to death created a positive swing of $31,875 in estate value. Now, the lower the state income tax rate and the greater the correlation between non-IRA and IRA assets that are subject to estate tax, the better this will work. So that's why I say this is a case-by-case situation where you have to do the math, but this is a good thing to think of when it comes to looking at the interplay between estate tax and income tax, because most of the time Roth IRA conversions focus solely on retirement needs and don't necessarily look to the estate's cash flow needs. So this is something to keep in mind ultimately. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.